Let's talk about one market that seems to be underperforming the region, actually, and that's Thailand. It seems that things are getting a little better. How much of the recent, uncertainty from investors, especially foreign investors, is linked to some of the questions about political uncertainty there? And do you think that the storm or the worst has passed for this underperformer in the region?
Yeah, I think the general comment I will make is that I think Southeast Asia, the ASEAN-4 countries specifically, I think they should see a tactical bounce. Now, if you just take a step back, I think one of the challenges investors have found for all these 4 countries has been the currency, because as the Fed was hiking interest rate, bond yields were going higher. There was always a pressure on domestic ASEAN FX. And now if you take the view that Fed is definitely going to embark on a rate cut cycle, this will allow some of these central banks to also embark on their own rate cut cycle, which would possibly support growth. I think tactically you should see all these markets actually at least outperform. But for us, Thailand, I think beyond tactical, I think there's a bit of a question mark on the growth outlook, right? But on the politics front, I would say it seems to us that probably the worst is behind us, and that's why we think there's an opportunity of a tactical bounce, just because the market was oversold, foreigners have been out, and as you said, it's been one of the worst performing markets. But beyond that, there's a question mark, what happens with the growth outlook.
So if we're looking at currencies in Southeast Asia really getting a boost from the Fed rate cuts, which market do you think might see the most benefit from currency strength until the end of the year, it seems?
Well, I think, we do have our FX forecast, but I would say Indonesia to me looks quite interesting. And I think there are 2 aspects to this. Generally, Indonesia has been a preferred market for most of our foreign investors from the equity side. Even on the debt side, there's always an interest in, the Indonesian bond market. So flows come and they start supporting the FX as well, right? So I would put Indonesia there. I think Malaysia should also benefit because Malaysia has an added advantage of, possibly rising current account surpluses on the back of all these, technology or semiconductor exports, which are likely to pick up in the months ahead. So I think those would be the 2 markets, 2 FX, which would stand out for me, and that's also another reason for us to actually be a bit more overweight on these markets.
What's the more compelling story between those 2?
I would say I think Malaysia is better, at least at this stage. And as I said, Indonesia is largely global macro. There's a little bit of, I would say, local factors also, but Malaysia has a much more compelling story. And I think this entire boom that you're seeing in AI infrastructure spending, I think that's really, benefiting many parts of the economy as well as the stock market. So you look at property stocks, you look at construction stocks, and I would argue even the banks, which are almost 50% of the market, they should also benefit if you assume that eventually all these FDI investments, supply chain shifts, AI spending will eventually lead to a pickup in credit growth.